In the past few days alone, AMC has ran up over $77 in the pre-market, so the question rises, is this the end for the AMC squeeze, or is there more to come? In this video, I'll be going over the details of the naked short selling of AMC, a new rule proposal which could cause the automatic margin calls, and my predictions on how AMC will likely trade this coming week. A lot has happened to AMC this past weekend, so let's do it. Recently, CNBC mentioned naked short selling over the weekend. Naked short selling is an illegal method of short selling, as many of you know, and it basically entails short selling non-existent shares. The reason that many of these huge institutions naked short sell instead of just regular short selling is because many of these momentum stocks may be hard to borrow at the moment because so many people want to short them. Hard to borrow just means that the broker does not allow short selling on the stock anymore, which could be due to a variety of reasons. The stock is too risky, the stock is too volatile, the borrowing fees are too high, etc. Because of this, it's easier for institutions to just illegally naked short sell because they do not have to get approved by any broker. The reason that institutions get away with this is because it's really hard to track, especially when institutions do it through dark pools, as I mentioned in videos before. There are also lots of signs indicating that AMC does have a high naked short selling rate, which is good for people who are looking for AMC to squeeze. Now, for the automatic margin calls. First of all, just to get everyone on the same page, a margin call occurs when the broker automatically closes someone's short positions because their account value falls below a certain amount. Margin calls are indicators that someone who's short selling a stock is losing lots of money. If a margin call occurs, the trader or the institution is forced to close their short positions at a loss, or they must post up additional capital to meet the minimum margin requirement. So the proposed rule change that could be causing the automatic margin call is the NSCC 002. The proposed rule suggests changes to the supplemental liquidity deposits. It says that they should change the liquidity deposit to be due on a daily basis rather than the monthly basis. This will likely cause a large number of defaults, and the interesting thing is, the NSCC is prepared for this. If we look at the risk management section, we can see that the NSCC maintains a clearing agency liquidity risk management framework, and it says that if a member defaults, the NSCC needs to complete the settlement of guaranteed transactions on the defaulted member's behalf from the date of the default through the remainder of the settlement cycle. This framework shows that the NSCC is preparing for plenty of defaults to come, and it could potentially trigger a series of continuous margin calls. So it's important to note when this proposed rule change will be approved or disapproved. Originally, there was supposed to be a decision made on May 7th, but they delayed their timeline to June 21st. We're getting close to that June 21st date, and over the last week, we've seen interesting things like the fact that Goldman Sachs, Citigroup, Bank of America, and Jefferies Financial have halted short sales of meme stocks like AMC, Microvision, and GameStop to protect themselves from too much exposure to risk. These banks usually have a high risk when they loan out shares to institutions that they cannot return. Because of this, to protect their own risk, these banks stopped lending out shares for these meme stocks because they expect a bad reckoning to come. I think a huge short squeeze could be coming for AMC based on all the data that we're seeing. Comment what stock you want me to cover next. Comment your thoughts on AMC. Peace.